and welcome back to another episode of the ICIS Energy Foresight podcast. I'm here today with Eduardo Simeoni to talk about the relationship between algorithmic trading and energy forecasting. Hi, Eduardo.
Hi there. Thanks for having me.
Eduardo is former head of short-term power optimization at Ørsted, and now has just started a new position in a new company, which is called Real, which has nothing to do with Facebook probably, but you're going to tell us a bit more about that in a while. And he's head of trading and flexibility. I think that's the right starting point, Eduardo. Can you tell us a bit more about the company you're working for? It's the new Danish startup, and what's your role?
Sure, definitely. So maybe briefly about myself. As you said, I'm an Italian that 10 years ago took the funny decision to move to the north, to the cold, rainy, dark north here in Copenhagen, which I'm actually really enjoying, to be honest. Studied at the technical university and then worked for Ørsted, which is maybe people know it, but it's the world leader in offshore wind, I guess, for roughly 7.5 years. And after that long of a time, I thought, you know what, it might be fun to try something completely different, a much smaller place, trying to innovate in the space of renewable energy and help in the green transition from a smaller startup. And I got the opportunity to join Real, which is basically a new type of B2B supplier. So the thesis of the company is that we want to unlock PPAs, so power purchase agreements of renewables for small to medium B2B customers. Because the big problem today is that PPAs are very complex contracts that are really only feasible for large corporates that have the money and the resources to basically negotiate these contracts, and the credit rating for developers that sort of is necessary. And the problem is that the majority of industrial demand in Europe actually comes from small to medium enterprises, companies that are much smaller than the Googles and the Amazons that are currently signing PPAs. So someone has to go there and try to unlock that market. And if we succeed, it could basically be definitely a boost for the green transition. So you can install even more renewables, because those renewables are going to be able to have better financing because they have fixed offtake contracts like PPAs. So we're a B2B supplier where the majority of the power is sourced through PPAs that are, very important to say, additional. That means that the power plant probably would not be built if you didn't have the PPA contract. So they help with the financing. And then we deliver basically the residual electricity to the customer through the spot markets. And by the way, if I'm using jargon or if there's any words that I need to kind of elaborate on, please just let me know. I will be guilty of using some abbreviations and funny jargon.
Yeah, no, I think that the PPA topic is one that actually we investigated in a previous episode with another guest, Mikkel Klink from our New Energy, which is also a company that is as a headquarter in Denmark, and we have started to look into PPAs as a company ourselves, ICIS, and it's a hot topic. And the pricing is still, I'd say, quite an element that is of interest, but obviously how that fits into the wider scheme of things with trading and optimization, and it's actually something very fascinating.
I agree.
And when it's about trading, and when it's about obviously looking at what are the current conditions that we are operating with within, what is your view in terms of the evolution of energy forecasting and algorithmic trading, and what's based also on your experience?
Well, I mean, it's a huge topic, and it's a super fascinating one in my opinion. I would say there's one trend that is kind of dominating the market, and that is the growth in installation of renewables is causing markets to be basically much more short-term, or that they need to be much more short-term, because renewable forecasts are uncertain all the way to basically a few hours before delivery. And so if you want to be accurate with what you're trading, it's much easier, it's much better if you wait until a few hours before delivery. That means liquidity kind of shifts towards the short term. And also, as a consequence, intraday markets have become a lot more liquid. If I'm not mistaken, the amount of power traded on intraday markets in Europe has increased by 50% just over the last year, which is quite a crazy growth rate. And if you go back a few years, the compound growth rate is quite spectacular. I heard a podcast this morning that the percentage of trades that are done through APIs on the continuous intraday market in Europe was 4% about 5 years ago, and is now 85%. So that gives you a sense of the amount of algorithms that are entering into the space. And it just makes sense, right? Because as markets become more fast moving, more liquid, more short term, you need speed, you need automation. And I mean, these are complex markets you have to trade because if you take the UK, just for an example, you have 48 products, one for each half hour of the day. Then you have 2 hour blocks, you have 4 hour blocks, you have 8 hour blocks. And so it's a lot of information to keep in the head of a person. I think in some cases, algorithms can do a better job. And that's actually what we've been seeing, quite a large growth of automated systems. So it's super interesting, this combination of markets moving more short term, getting much faster, the amount of information that you need to sort of process is increasing. And then weather is obviously becoming more and more important for price movements, because it's one of the main reasons why grids have imbalances. Is windier than expected, or sunnier than expected, or the opposite, or colder, and so on. And so it's really a trifecta of very interesting phenomena, I would say.
And the degree of automation which is needed, and the idea of moving away from humans taking decisions, where it's about effectively trade the different trades, and delegating that to algos somehow is going to affect a lot the forecasting bit, because obviously an algorithm is how that functions is somehow set up by fixing a few rules or a few objectives. And how do you see that relationship going forward? Is energy forecasts going to be still relevant when 100% of trading in certain markets is done by algorithms?
Absolutely. I mean, especially if you look at weather forecasting, and if you trade renewables, the accuracy of your weather forecast is the number one driver of your balancing costs. So that is basically the cost that it takes to bring your power to market. And the reason why there's a cost is exactly because you cannot predict your production completely accurately at the day ahead stage. So no matter how you trade the volume, whether it's automated or manually, whether it's using auctions or continuous markets, you need as accurate of a weather forecast as you can get. Then I think there's an interesting development that we're starting to see now. Sort of the state of the art today of weather models is based on physics modeling. So basically explicit modeling of the equations that govern fluid dynamics and the weather. But you start to see emerge more like machine learning approaches that are very good, it seems, on the short-term side, so forecasting a few hours ahead. So seeing how that's going to develop is also going to be interesting. But there's no question that accurate weather forecasts are going to be important, no matter where the automation goes, I would say.
And obviously, this is highly relevant in an environment where renewables make up most of the supply side, right? Can we, and this is true for the power market especially, right? Do you see that also expanding into other markets like the gas market or potentially the hydrogen market, and or algo is, let's say, as limited applications in those markets because there are not as many data and there is not as much data as is the case in the power market?
So I would say algorithms in general can be used everywhere because it's just about speed, and that's typically good in most cases. But on the other hand, they shine in situations where there is a lot of data and where frequency is really high and the number of products that you can trade is really high. So I think structurally, there's a huge need for automation in short-term power markets. You may have a little less in gas markets, for example, where the products are daily and sort of it's less on a short-term basis, also because gas can be stored, right? They can be pulled in and out of gas storages. But on the other hand, for example, if you look at the most liquid commodity market, that's oil, I'm pretty sure there's a large chunk of trades that are happening in automated ways, especially kind of market making strategies. So I would say they're almost like a Swiss Army knife. They can work kind of everywhere, probably for different reasons, right? In power markets, short term, we're seeing the prevalence of algorithms in two types of strategies, I would say. One is market making strategies, so where you're trying to just lower the spread and profit from that bid-ask spread. That you must do with algos. There's no way humans can do market making strategies today in power markets. Then the marketing of renewables, I would say, which just is easier in my head, at least, if automated, so then you can integrate it with all these data sources that we talked about. And the market making case applies perfectly well also to the gas market and to other commodities. So I would say they're a very general tool. But on the other hand, I'm also pretty certain that you're not going to see a full disappearance of human traders. It's a little bit like the stock market, right? Where, yes, you have the high frequency traders, the Jane Street, the Renaissance Technologies, those guys, the tech heavy firms, but you still have Warren Buffett, and he's still making a lot of money. So and that's a very human driven, non-automated way of trading. So I think you can see both also in energy markets. You're trading long products, like, couple of years ahead where liquidity is reasonably low, and maybe you bet with huge amounts of money, then it makes sense to be slow. And then maybe it's the best way to make that trade is to have a person behind really thinking about the trade before they do it. If it's a lot of volume that you're trading back and forth, then probably algorithms are more important.
And on that, I would try to be a little bit provocative, and I think probably it's a nice place to also and this very present conversation. If we look at as you said, the short-term market, algo is a perfect use case, a perfect application for that, given the large amount of data. If we move more into the space of the forward curve, or even say longer term, what we have seen over the past decade is that there was a high focus on machine learning and a lot of applications also for the mid-term to long-term time frame. But then COVID happened, the war in Ukraine happened, and a lot of models were just basically thrown out of the window. How do you see the interaction between the two? Is it like machine learning and potentially AI, since everybody is basically served for breakfast every day? Are those, let's say, useful applications for those time frames, or we're still talking about different models for that?
I would say it's a completely different game, right? If you're making a bet that it's a multi-year bet, as I said a little bit before, you're probably making a large trade that you need to evaluate under different scenarios. And that's not something where really AI or machine learning, whatever we want to call it, or statistics, which is really the umbrella term, if you want, can really shine, because the statistics are irrelevant. You could not have forecasted with machine learning something like the war in Ukraine. The only thing you can do in a situation like that is have a person ask themselves the question, what if, right? So what if Putin goes crazy? What if we have a couple of cold winters in a row? What does that do to the price? What are the fundamentals as a consequence? And therefore, what's the risk reward on my trade? So I would say completely different use cases, right? Algorithms and machine learning forecasting can work really well on the short term to basically spot patterns and highlight momentum and things like that, but really in a compressed timeline. And as we said, the perfect example of that is power markets, where you're trading 1 or 2 hours ahead and that's it. But when you make multi-year bets, the amount of uncertainty is so big and the data is so scarce that machine learning is completely useless, if you ask me.
Yeah, I couldn't agree more, and that's also the approach that we have taken at ICIS, with the idea of integrating different models and start asking those questions. What if? And then what's the implication across the different markets?
It's really scenario planning more than forecasting, I would say, right? So I think when you're looking far ahead enough, I think people that try to predict where, for example, people that try now to predict how cold the winter 26 will be, they're joking. Oh, they're kidding themselves if they actually think they can be any accurate in forecasting that. There's no way you can actually have an accurate forecast that far ahead. What you can do though is work out the what if, the scenarios, right? And then therefore make evaluation on your trade in one situation and the opposite situation and work out your risk reward. That's the rational way to do it, in my opinion.
Eduardo, thank you. I had fun. It was really enjoyable. And good luck with your new job. And I hope to see you again in another episode of the Energy Foresight podcast. And as always, if you want to know more about Energy Foresight, visit our website, ICIS.com. Till the next time.
Thank you.